Let's get you set up with tomorrow's trade. Today, look out for the latest reading on inflation when the June Consumer Price Index lands before the bell tomorrow. Prices month over month expected to rise to 0.3% from 0.1%. And we'll get a slew of bank earnings before the bell. JP Morgan Chase, Citigroup, Wells Fargo, BlackRock, and Bank of New York Mellon. So what should you do with the banks? Joining me now is David George, Baird Senior Research Analyst. David, regionals or the big banks?
Hey, John, I would say regionals. From our perspective, the risk-reward trade-off, and banks to us, John, are really risk-reward stocks, and the risk-reward trade-off we think is simply better in the regional banks. You've got a record dispersion between where regional banks are trading relative to the money center banks, really the longest that we've seen in the 25 years that we've done it. So expectations are high going into tomorrow. So we're a little concerned, John, about a sell the news event tomorrow on what is going to be, we think, pretty good numbers. But again, expectations super high given where the stocks are trading here.
Now, the KRE, the regional banking ETF, is up above 63 right now. It was down below 40 back post SVB. That's quite a run. Is it the whole index that investors can buy, or do they have to be really selective?
From our perspective, so the BK or the KRE you mentioned is largely regional banks, and from our perspective, you want to be generally selective given the move that we've had. When we were together 3 months ago, that was the time to get aggressive on bank stocks, and many stocks are up 30 to 40% during that period of time. So we're of the view that you're going to get a better crack to buy these stocks as we go through the balance of the year. From a risk-reward standpoint, we're a little bit elevated on the risk side and a little bit limited from the reward standpoint.
Whether we're talking tariffs, taxes, interest rates, how does policy affect the banks right now?
Well, just like the rest of the equity market, the tariff issue has really become a non-issue, and I think that cooler heads have prevailed with respect to kind of longer-term expectations, and we're of the view that we're probably settled between a 10 to 15% aggregate tariff limit. There's also some optimism around potentially Fed cuts. The 2-year and Fed funds futures are pricing in 75 basis points of cuts by the end of the year. So that would have, we think, some positive implications as it relates to the regional banks and the money centers as well, as you start to get a little bit of shape of that yield curve, and that also would be constructive for capital markets activity at the same time.
Do you have to parse through these names for consumer and maybe even subprime exposure?
Yeah, there's really a fairly limited subprime exposure. The likes of Capital One and some of the others in the consumer finance space have some more focused exposure around the non-prime area. But we're obviously going to be looking at all parts of the credit spectrum when we get these numbers the rest of the week, consumer, commercial. And I think the focus over the next several quarters from a credit quality standpoint is not going to be just the consumer, but also corporate profit margins, particularly for small and medium-sized companies. There will be, we think, some losers as it relates to tariffs, and that's going to manifest itself, we think, in the form of lower corporate profit margins, and that over time we think could result in losses moving higher. But certainly this week and next week when we get more regional bank numbers, credit quality should continue to hold in pretty well, we think.